A very good evening to all of you. Today we are going to discuss the Slfrs 16 or IFRS 16 lease standard. So before moving to the calculation, we want to have in-depth understanding about the background of the lease, how the leases emerge in the context of the business. So here the contents that we gonna discuss today. So SFRS 16 came effect on 1st January 2019 onwards. After that, the previous LK 17 will no longer apply. The objective to specify that the principle for recognition, measurement, presentation, and disclosure of the leases, right? The objective is this. The overview, SLFRS 16 newly standard is required to be applied for annual periods begin on or after 1st January 2019. SLFRS 16 subsidies the following. These are abolished. These are not not longer valid, right? After becoming effective on SLFRS 16. So the introduction criteria. So here you can see the Slfrs 16 single accounting model. No classification in here. There is a classification: finance lease, operation lease, sales and lease backs, like that. Those are now not applicable. So you can go forward. So overview, what are the overview leases major changes? So in the statement of financial position, previously we called as balance sheet. In here we record the asset under the non-current asset, right of use asset, ROU asset, simply we call as ROU asset, right of use asset. And the liability, so liability, and also we have current liability portion of for the lease liability, as well as the non-current liability for the lease liability, non-current liability for the lease liability, right? So the P in the P&L, depreciation, amortization, and the lease interest payable, the front loaded or total any expenditure that incurred on behalf of the lease should be recognized, right? What is lease? A contract that conveys the right of use, control the use of identified asset, that is we call as a ROU asset, of the period, particular period, we call as a tenor. Lease term. Lease term is there, tenor. In exchange for consideration, also we can't get a free. It should be a commercial substance, right? Exchange for a consideration, that is we call as a lease payment, right? So the contract, it can be, it should be a written contract, because leases are not verbally or by implied, not their leases, but in writing form. These contracts should be lessor and lessee. The lessor provide the asset, underlying asset, to the lessee. Lessor is who provide the lease facility. Let's say a bank. Let's say we say CDB bank, CDB finance. Lessor is the who provides the financial facility. Lessee is who taking the, who request, who borrow the leasing facility, who borrow the leasing facility. So in here, underlying asset is given by lessor to the lessee. On behalf of that, lessee is liable to pay consideration or agreed lease term, lease payments to the lessee, sorry, lessor. So lessee is needed to pay agreed lease term, lease payments to the lessor on behalf of using the right of use asset, right? Right. With that, we can go forward. Recognize of the recognition criteria. So is there is an unidentified asset that customer has a right to use. Right to use should be there. Right to use should be there. Right to use. No, there is a no lease. Right. If there is under not right to use of that particular asset, there is a no lease. Does the lease obtain substantially all economic benefit, not rather than there is any restriction for the user, for the lessee? If yes, does the lease have a right to direct? Does the lease obtain substantially all economic? If there is a restriction for that particular user, there is a no lease contract. But These things are years, years, years. No, definitely you want to ask in here, does the lease have a right to direct? Right to direct means all the commercial benefits are pertain to that particular lessee. Then, of course, there is a lease contract. The contract contain a lease. The identification is very much important. Recognition. So you, later on you can discuss identification of recognition. The lessees are required to initially recognize lease liability at present value of future cash flows. Lease liability measured at the present value of the lease payment. It with discounting implicit rate of return use lease term or tenure. The entity shall determine the lease term as the non-cancelable period of lease together with both periods conveyed, so covered by the option to extend. The option to extend are not in your level. Period covered by option to terminate, those also not there. Discount rate, in order to discount the present value of, get the present value of future cash flows. In order to discount it, you have rate implicit on the lease, it is given if readily determinable, otherwise incremental borrowing rate. If there is incremental borrowing rate is given, you want to use that. If not, they are given implicit the rate of return. Younger poly anupate. So the right of use asset initially measured at lease liability plus the lease prepayments. If there is a down payment, you want to add here, and lease incentives you want to minus it. If the down payment is 1,000 and you get a lease institute 500, let's say 100, the actual down payment is 900, right? Right. Direct cost you want to add commissions. So the dismantling provision as per the LK 37. Those things you want to add back, right? Initial recognition, ROU asset, right of use asset, amount for the lease liability, these prepayments made at before the commencement date, down payments, initial direct cost, legal fees like that, legal fees like that, the estimation dismantling provisions after. So you have to add back those things. Lease liability, DC shall measure the present value of lease liability, discount rate in implicit that particular lease arrangement, right? So subsequent measurement is, I think, continuous receivables. You can later on refer this. So now move to the last year question paper, right? Last year paper is this. Very easy question, 10 marks, but Lago Limited acquired a machine via a lease arrangement on 1st April 2020 from Lead. The lease was 5 years. The lease tenure is term is given 5 years. The rental is 20% is installment for payable in arrears. So lease in also we have two types, payable in arrears. At the end of the each year you want to make the payment in advance at the beginning of the year. The advance is not in your level. Those are in second year, I think. As we would not yet learn those things paid in advance. But if you are doing chart at corporate level, definitely you want to know the thorough understanding that is the particular area, right? The implicit rate of return, implicit rate is given 7.3%. The lease liability is given, but when we are doing this paper, our cost line does not contain SLFR 16. That's why they are given. But in your I know that in you learn about in these lecture slides. So you want to how to calculate this the present value of future cash flows in 5 years, ne? 3, 4, 5 years, right? The cash flows. This is 20%. 20,000, not 20%, right? 20,000. After discounting factor into implicit rate of return 7.93. After you discount these things and multiply it, you can get the present value. I will show you an Excel template for that. Just give me 1 second, right? Here you can see here how I compute these things in here. You can see lease liability year 1, 20,000. The discount factor is, you know, that 1 divided by brackets 1 plus R is in here 7.93%. into the power 1, right? I don't know if you know these things or not. You can equal mark, you can get this one. Here, this one, right? I round off to the latest last four decimals. That's why after that you can get this. This is given in this paper, right? 80,000, but in your case it is not given. You want to calculate it. After that you want to prepare the lease amortization schedule in order to identify at first year, at the end of the first year, what is the lease liability, at the fourth year what is the lease liability. Likewise, if the examiner asks what is the lease liability of the end of the fourth year, you want to better to prepare this one. It's direct not tested, direct not saying, but if you can, you want to, if you can name it, definitely you want to prepare these things when it comes to the answer the questions, right? Here the question asks, calculate the non-current liability and the current liability figures shown Lago first 31st March 2021. It means at the end of the first year, right? What is this? The non-current liability this year? You can see here. Here is the at the end of the first year, the balance carried down amount. So now current portion, how to calculate? Lease payment, this 20,000 minus the next year interest payable. This is the current portion. If it is non-current liability, what is the non-current liability? Total, you want to total minus this amount, then definitely you can get easy, right? I told you this is easy, right? This is the answer. Right. In second question, they ask you describe the right of use asset determined by Lago. Easy question. If there is a, you want to how to determine ROE asset, I told you, but ROE asset, these liability should be there. Initially is liability. Let's say there is a down payment in not given in this case. Let's say the down payment 50,000. You want to add back. There is a legal fee. Let's say legal fees. Uh, let's say 15,000 is there. You want to add back. And the dismantling provision, not, it's not required here. This is the initial lease liability, right? Initial is, sorry, right of use asset, initial ROU asset, ROU asset, right? This is the simple case in your level. It is tested, right? Oh, thank you. Hope you will get a good understanding. Thank you.